Hello, good afternoon. Welcome. See, we have a nice turnout today. Today is Thursday, April 24th, 2014. I'm Chris Chelius with the Option Ranger Group and Time Leverage Capital. And welcome to Panic Index, or the Volatility Index, an answer to large-scale crises. So for an important disclosure first, please be aware that trading futures, options, stocks, and stock options involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. Be sure to read and understand all disclosures before investing. All of the examples discussed are for educational and illustrational purposes only. Our examples are not individualized trading advice. Each person must ultimately make decisions based on individual risk tolerance and financial objectives. If you, at any time during the webinar, you have questions or ideas, type them in the chat box and we'll do our best to answer them. And our presenter today is Mr. Adrian Mueller. He is the lead developer of the Option Ranger software and served as chief strategist of Dow Jones Megatrends in All Markets newsletter. Mr. Mueller is the founder and principal of the independent Introducing Brokerage Time Leverage Capital and a former stock option principal. The program in which you are participating was developed over many years and is designed to train professional brokers and to provide user-friendly educational programs for individual investors. So without further delay, let's start Panic Index or Volatility Index in answer to large-scale crises. Mr. Mueller.
Thank you, Chris. We are going to start the program, but we're definitely not going to start to panic because we're going to be modeling the markets and coming up with a plan. So let's go directly to a discussion of volatility and specifically as to risk in the markets. So first and foremost, we like to use quotes. There's folk wisdom out there, and we know the importance of it. Ralph Waldo Emerson had a great statement, which was knowledge is the antidote to fear. And in today's environment, when people are very fearful of the market, it's important to have the right kind of knowledge to understand that fear. Of course, there's another great saying called knowledge is power. And again, in this case, we might say that knowledge gives us some power over irrational or unreasonable fears. On the other hand, we can certainly see why there is a lot of fear and panic embedded in the minds of investors today, not just based on short-term events and lack of confidence in the federal government, in the legislative process, in financial policy, in the debt, and so on. So while the markets have done relatively well of late, it is understandable that while seeing an up market on one side, people are fearful on the other. So let's see first and foremost why it is reasonable for people to be afraid. First of all, let's look at a very long-term study of the Dow Jones, the benchmark index of the large industrials, at over 100 years. This really does give us a very big picture. On the left side, we see the volatility. Volatility meaning how bouncy is the market, how large are the moves in either direction. And in the volatility index, we actually have a concrete measurement of volatility based on option premiums on the S&P. So now let's first look at the Dow Jones, and then we'll look at some S&P examples. As you can see, again, looking at real long-term fear, and some of our more mature clients may remember, or certainly, and we all know anecdotally, the major events in history. We're looking at the crash of 1929, which in terms of volatility took volatility well over 100. And 100 basically is a number here of percentage points that option prices are factoring in as a movement in either direction. So during this such massive moves, huge moves are factored in. As you can see, an index here went from a relatively low level when confidence was high all the way to 120. Parenthetically, and I'm not saying we're going to have that kind of move, in dollars and cents, and we can demonstrate this on a calculator. Today, let's say a move from approximately 15, 16 where we are, let's say to 115, let's say from 15 to 115 is a 100-point move, and every point being worth $1,000, that move today in terms of the VIX would be a move to the upside from 15 to 115 of $100,000 on the VIX futures. Again, this is a rare, extraordinary, and unlikely event, but it shows us why people are scared and why there's a fear and panic factor. And as we can see, again, looking very long term, and we'll put some fundamentals to these events. We've had moves to 80. We've had moves to we had a couple of times getting into the 60s. We had times getting into the 50 range. A fair number of opportunities in the 40 range. And again, if you take a market from 15 to 40, that's 25 points. That's $25,000 on the move up, and it's 1,000 on the move down. If you can look at this also in 1987, so this is a more modern event, not so much in the remote past. We can see in the crash of 1987, again, there was a very significant spike up in volatility, and we're going to go on some particulars there and on multiple occasions. So people are right to be afraid of volatility, especially because panic and fear are the ones that move these indices the most. Unfortunately, most people end up losing money on large drops and panic events, and very few people take advantage of them or even know how should they choose to. There's an old saying, crisis spells opportunity. In fact, President Kennedy famously mentioned that in the Chinese ideographs and the images, the symbols for crisis and opportunity are extremely similar to indicate that for the wise, again, a crisis can be an opportunity. Let's have a look again at the prices historically, and this we're narrowing in on a smaller time range. Now we're going to go back to October of 1979, excuse me. And as you can see here, we have the prices for the S&P indicated in the green, and underneath we have the volatility, the historic volatility during those time frames. And again, as you can see on a more recent move, there were several spikes here previously, again into the 30 and 40 range, 20 being a relatively low number looking at this historically. And if you look again, you'll see the periods of very low volatility are periods when the stock market was very stable and things went smoothly. So for instance, during the astonishing bull market of the 90s, of course, which led to a NASDAQ bubble and other events that we'll see later. So as you can see, if you see a sustained period of low volatility, chances are that the market is calmly trending to the upside, and somebody who trades the VIX as a corollary to manage volatility in a stock portfolio, while the volatility was low here and the VIX would not have been a profitable transaction, the counterpart of consistent up moves in the stock market would have made, or in likelihood could have complemented and made up for that difference. And then when the corrections came, even if they were very short-lived, as you can see, you have spikes into volatility close to 40, beyond 40 a couple of times, again close to 40, and certainly in the 30 area, even during what would otherwise be considered to be overall fairly bullish markets, because when market drop, panic sets in, volatility picks up, and as you can see here, even on events that came and went, as we have here in the case of 2008, you see a significant drop followed by a very significant rally that overcame previous losses, and however on that drop, the volatility increased significantly for an opportunity. George Soros, who was a co-manager of the Quantum Fund with Jim Rogers, famously wrote, "Markets are constantly in a state of uncertainty and flux, and money is made by discounting the obvious and betting on the unexpected." This is really what volatility is all about. When news are in the market and the market is overly complacent, it is a time to look for volatility or perhaps some unexpected event to increase volatility. When there's tremendous panic, again, that one can look for diminishing volatility as the situation resolves. So let's look at multiple events, and now we're even in a shorter time frame. We're only going back to about into a part of 97, 98, and not even having some of the more recent events. And you can see the Asian contagion, not really very expected. So in the top here, where you see the S&P 500 index, you'll see on various drops or various small corrections or even larger corrections, the volatility index increased significantly. So let's take these one at a time, and we can look at particulars and prices and examples soon. Some of these events many of us don't even remember or seem to be in the remote past, and yet at that moment they created so much panic and fear that option prices exploded and the volatility index picked up significantly. Take, for example, the Asian contagion, which we can vaguely remember back in late 97. There was a short-term, short-lived drop in the market on the usual panic and fear that comes out with any adverse news. And while the market pulled back a little bit here, we see that the index itself rose above 40 from a previous level of, shall we say, approximately 20. So that move was literally from 20 to 40, and again, this is an approximation. You're looking at a $20,000 move in the index against this drop, and of course, if one offsets that at some point, nobody knows where or what the ideal is, that would be a significant gain on volatility, notwithstanding the fact that the market resumes its uptrend. Now we have another unexpected crisis, certainly I didn't expect it, which is the Russian debt crisis. This came not that long after, and again, what we saw is, again, a very complacent period. The Asian contagion was fixed. The market continues to go up, and there's another entirely, certainly when you look at the price action event, except with the benefit of hindsight, what everybody has, as you can see, the Russian debt crisis created another fall. Didn't even go as far down as the fast-forgotten Asian contagion, and yet, on that Russian debt crisis, we see moves here that neared the 50 level, again, from hitting lows around 20 or thereabouts. So again, from 20 to 50, on the upside, on rising volatility would be a 30,000 move, and of course, if somebody was facing in the wrong direction and bought volatility at the highs and it went down, of course, they would be losing a commensurate amount of 10 per ticks. So let's say if they bought at, shall we say 50, and the market goes back down to 20 and they're long, then they would lose the 30,000 being wrong here as they did being right. The one thing I can say is that there does appear to be a floor to volatility insofar as option trading and premium to some extent will always be there, and for options to trade there has to be some kind of a premium aspect that is measured as volatility. So there is, just as fear never totally goes away, option premiums as time value can't fully go away. You can see that at low levels, low fear, low concern can result in various moves. Now again, you see that after the Russian debt crisis, everything is forgotten again. The market resumed their upside, and the volatility and the fear factor begins to drop as you look at the volatility levels here. And then sure enough, although everybody talked about it for a long time, nobody seemed to believe in it. The market is back down here, maybe around the 20 plus level on volatility. Trading during that up market, nobody has any fear. All of a sudden the internet bubble is pricked. You see, again, a fairly short-lived drop here, followed by a rally, but nonetheless, the volatility broke out above 30. So again, from 20 to 30, that would be a $10,000 increase in a single VIX contract. And then, of course, as you see the market continuing to drop here, the more it drops, you see other spikes in volatility, multiple moves to 30 and beyond. And then finally, on 9/11, and of course that moment is embedded in everybody's memory, we see that there was a move. Again, this move is above is a significant spike above 40, between 40 and 50. So again, if somebody had picked that up around 25 when the market was relatively tame, this unexpected event immediately spiked the market, and it could have taken the damage out, depending on the level of coverage, of a significant drop if long. And as you can see, it goes on. The subprime crisis created a significant spike in volatility in 07. I think everybody remembers that. The Lehman Brothers crisis, of course, in 2008, significant spike. We see the market here going up to a very significant level, over 80. In fact, that level was 80, just under 81 on the close on its high. So again, if somebody had purchased this volatility index during a quiet period, and again, here we had a relatively low volatility period again prior to the larger drop, that might have made a move from 20, 21, 22, 25, whatever, depending on the entry, all the way up to 80 plus change. And again, nobody has a perfect exit, but there's a lot of room, let's say between 25 and 80, there's a move of 55 points, of which one can attempt to get a piece on a big volatility spike, and that would be $55,000 per position. Again, we go to the flash crash, which was a non-event except for the fact that it spiked the volatility close to 50, again from levels under 20. So if you look at under 20 to 50, let's call it 30 points, that ideally would be 30,000. Nobody gets perfect entries and perfect exits. So in all likelihood, there's still a lot of room in the middle there, assuming somebody got long on low volatility. And one has to be mindful where to take a profit, because if you don't trail a stop, which doesn't guarantee a fill, or you don't have a strategy to exit, the market can turn around and lose as much per tick going down as it makes per tick going up if you're long. Finally, we have the worldwide credit freeze, another significant move, and of course the European debt crisis. And that European debt crisis, which is hardly an event, especially if you look at what happened in the markets afterwards, nonetheless moved the index close to 50 from below 20. So long term, although there are flat periods, as you can see here, under 20, at some point or another, getting long selectively under 20 with patience and with a longer term plan seems to be a strategy that will work if an unexpected crisis, as all of these crises, is going to develop. Now, so let's go ahead, and again, the important factor here, and I do want to go to our quote, is that George Soros again said that markets are constantly in a state of uncertainty. We know that to be true, and flux, also true. And money is made by discounting the obvious, which is where we are, and betting on the unexpected, which is when things are quiet. In this particular scenario, people bet on an unexpected event that would spike volatility. And when things are overly volatile, for people who want to reverse that, they can short the index betting on diminishing volatility, which is a risky move. Again, just to look at some of the particular events and the size moves, and we've seen some of the corresponding increases in the VIX, as you can see at various points in history. Certainly the 2008 stock market crash, we're talking 37%, and here, again, for people who don't want to do their own trading or self-directed, we show that certain uncorrelated indices that could go short as well as long, that could trade volatility, were able to outperform. In terms of dealing with the VIX and dealing with fear in the markets, and much of this is very psychological, we have to look to the wisdom of Mark Twain, who's one of my personal favorites, because his wisdom is everyday wisdom, but also extremely educational. And he said, courage is resistance to fear, mastery of fear, not absence of fear. And of course, we know the saying also, there's nothing to fear, it's fear itself. And this is really the point. In many cases, when people see these types of figures, they see these types of statistics, they see these types of drops, and fear that these kinds of drops or worse could occur, it is understandable that there's a tendency not to react, not to plan, but in this particular case, knowledge, acceptance that the fears are valid and need to be addressed, fall very well in line with Mark Twain saying that first of all, one must resist that fear and master it and understand it so that they can take the correct actions. And this is the instrument that we've been talking about in the examples that we have shown, the volatility index, which is traded on the CBOE, the Chicago Board Options Exchange. The symbol is VX. The contract size is $1,000 times the index, and the minimum tick is $10 per contract. And we've listed the margins, which again will change from time to time in order to establish a position. So every point, as you can see on the contract size, every point is worth $1,000. Every tick is worth $10. And we are going to go ahead now and look at a couple of additional examples. And now we're going to take this again even into a narrower time frame, going to January of 1990. And again, as you can see some of these examples, the VIX is in orange, and the S&P, the SPX, is in blue. And again, as you can see, when there is sometimes even a short-lived drop, there are major spikes in volatility, and you can see that we've broken to and above that 30 level multiple times. When we didn't, and when volatility was very low, was in periods of complacency, when the market was going up and there was a fair level of confidence that nothing could go wrong. Of course, as you can see, in '07, when the market took that big drop, the VIX really picked up. So that's really why they call it the panic index. You see again here another drop here, and the corresponding spike in the VIX to a high level. Again, as you can see here, all of these spots here, that's 60 in the VIX, that's 30 in the VIX. This would be somewhere 45 and 40 in the VIX, which has been hit multiple times. And again, when the S&P went up very confidently, so people in the stock portfolio were making money, if they were afraid that something could go wrong, there could be a big correction, and they bought the VIX to hedge, in all likelihood they would be losing on the volatility index because there's no fear and there's no panic, but they would be making money also on their S&P. It is sometimes also possible that even in the midst of mostly up moves, as we've seen, you can have various short-lived spikes in the VIX on which you can take advantage in the shorter term. There are also multiple indices, as you can see, so we can track the volatility in other markets in order to also see appropriate entries and appropriate premium plays. We can do that, of course, for example, in the gold market, and you can track volatility as well in the oil market in order to be in those markets. So what we're going to do now is we're going to invite everybody here to contact us. We've done quite a few examples, but based on the portfolio size, based on the level of risk that you carry in the market, or just based on your expectation to work out a specific example. And now let's go to a current chart on the VIX. This is a weekly chart, so we want to really look at the market long term. And this is the volatility index. As you can see, and this is kind of where we're settling today or going to settle. This is where the VIX presently, which is on a weekly chart, I would say relatively a low level compared to some of these other numbers. Where I start this chart out is in we start this out in 2008, where this number actually went higher above 80. But as you can see, again, we've had in December of '08 we went close to 60. Again, we hit 55 again in '09. So there are multiple spikes and drops here. But if you look at a long-term chart, notwithstanding those large drops, we are now working our way in this area. And for those that think the market is too complacent and things can go wrong, and there are things to be concerned about, that the market could drop or some kind of geopolitical instability event could occur, maybe Putin will do something out of hand, maybe Iran is going to provoke a confrontation, maybe something happens in Syria, Saudi Arabian blow up or some entirely unexpected weather event or other, these are the levels in which we are currently looking, where if people feel that things are too complacent and something could go wrong, or they want to counterbalance portfolio risk in stocks with some kind of a volatility play, this is where the market is right now. And in fact, if you look at a daily chart, I think it's even more obvious that we are getting into a bit of a trough of complacency, at least in the short term, where some people might want to strongly consider an entry. And for individuals, especially if they're going to be trading against a stock portfolio or speculating, that's two different scenarios. So it's very important to know which you're doing so that you can work out the right risk and reward plan, both for your portfolio, if it's a portfolio approach for risk management or volatility management, or whether it's an outright speculation that the markets are going to get more volatile and crazy. So please don't hesitate to contact us if you would like to run an example on how the VIX can work dollar for dollar, either independently or against the stock portfolio. We'll be more than happy to work out an example for everyone individually using our software. Many of you are in our beta group, so they know how the software works. But we'll certainly help set up an example for you or a tab for you if you need it. Okay, do we have any questions right now, Chris?
Not at this moment, Mr. Mueller, no.
Okay, outstanding. That means that I did a really good job of explaining everything. Thank you all for attending. Have an outstanding Thursday, and we'll be continuing next week with some specific examples on the stock indices, volatility, and the volatility index. Have a super day, and thanks for being a part of the program.
Yes, thank you, everyone. And again, feel free to contact us at 800-628-4630. That's 800-628-4630. If you have any questions or would like to look at your portfolio with Mr. Mueller, and if you have any other questions, feel free to contact me, Chris Chelius, at 800-628-4630. Everybody have a fantastic day and a fantastic weekend. Take care. Thank you.